In this class, we are discussing swaps. Swaps are forward commitments like futures and forwards. A swap is an agreement between two parties who commit to exchange a series of future cash flows. Examples of swaps include interest rate swaps. In an interest rate swap, there is no exchange of notional principal. The cash flows exchanged are a swap rate, which is a fixed interest rate, which is exchanged then against a floating rate, and the floating rate, that's then a reference rate in the money market, such as the EURIBOR for the euro or the compounded Swiss average rate overnight for the Swiss franc. A next example of a swap is a currency swap. Unlike interest rate swaps, the notional principal is exchanged. We have a notional principal in one currency, which is exchanged against the notional principal in another currency. The interest payment takes place on the currency received. Interest exchanged are a swap rate in one currency is exchanged against a swap rate in another currency, or the swap rate in one currency is exchanged against a floating rate in another currency, or a floating rate in one currency is exchanged against a floating rate in another currency. A further example of a swap is an equity swap. With an equity swap, the return on an equity position, the equity position can be an equity index. The return on one equity position can be exchanged against the return of another equity position or against the swap rate or the floating rate. Non-financial swaps include commodity swaps, credit default swaps, and total return swaps. We have already discussed in a previous class credit default swaps, which is a credit derivative, same as a total return swap. And in a credit default swap, the CDS risk premium is exchanged against a one-time payment if the underlying defaults. The focus of this class is on interest rate swaps. In an interest rate swap, both contracting parties exchanged a fixed interest payment for a floating interest payment in the same currency over the same time period. For example, the swap rate, which is the fixed interest rate, is exchanged against a reference rate in the money market every 6 months over a period of 5 years. There is no exchange of the notional principal. The notional principal is only used to calculate the interest payments. The fixed interest payments are calculated by multiplying the notional principal by the swap rate, while the floating interest payments are determined by multiplying the notional principal by a reference rate in the money market, such as the EURIBOR or compounded euro short-term rate for the euro, or for the Swiss franc as a reference rate, the compounded Swiss average rate overnight is used. The interest payments can be and nearly always are netted. Unlike futures and forwards, the terminology long and short does not exist with swaps. Rather, we distinguish between a payer swap and a receiver swap. The holder of a payer swap pays the swap rate and receives the floating rate, while the holder of the receiver swap receives the swap rate and pays the floating rate. Hence, the terms payer and receiver refer to the fixed interest payments. Market participants enter into a payer swap at the higher ask rate and a receiver swap at the lower bid rate with a financial institution. Like forwards, swaps are traded over the counter, typically through electronic trading platforms. Let's take now a look at the bid and ask rate at which market participants can enter into an interest rate swap. Financial institutions are offering interest rate swap at the bid swap rate and at the ask swap rate in the market. So we have a bid swap rate and an ask swap rate. And I just include the financial institutions. that are offering the interest rate swap to other investors in the market, and investors are then other financial institutions or non-financial companies. Please note that the bid swap rate is lower than the ask swap rate. If investors want to enter into a pair swap, then they can do that at the higher ask swap rate. And the counterparty of this pair swap is the financial institution that enters then into a receiver swap. If investors want to enter into receiver swap, then they can do so at the lower bid swap rate. And the financial institution is entering then in the opposite position, so into a pair swap. The profit of the financial institution that is acting as an intermediary is given by the bid-ask spread for the swap rate. The financial institution receives the higher ask swap rate on the receiver swap and pays then the lower bid swap rate on the pair swap. Let's take now an example to illustrate this concept. Let's assume the following interest rate swap. The notional principal is 50 million euros. The maturity of the interest rate swap, which is also called the tenor of the swap, is 5 years. And the interest payments take place every 6 months. The floating side of the swap is given by the 6 months EURIBOR. And the swap rate offered in the market by the financial institution has a bid rate of 2.33% and an ask rate of 2.36%. To demonstrate how to calculate the yearly profit of the financial institution that is acting as a financial intermediary in the market, let's start with a pair swap. So the financial institution enters into a pair swap. So that's then the financial institution. I'm just writing here bank for the financial institution, and the other party is an investor who enters in the opposite position, that means into a receiver swap. The bank, as the holder of the pair swap, pays the bid swap rate of 2.33% every 6 months in exchange of receiving the 6 months EURIBOR every 6 months. Then the bank can enter into a receiver swap. and the other counterparty, the investor, enters the opposite position, which is a payer swap. The bank, as the holder of the receiver swap, receives now the ask swap rate of 2.36% every 6 months in exchange of paying every 6 months the 6 months EURIBOR. If we take the view of the bank, then we see that the 6 months EURIBOR cancels out. On the payer swap, the bank receives the 6 months EURIBOR every 6 months and pays on the receiver swap the 6 months EURIBOR. So the 6 months EURIBOR cancels out, and the bank receives on the payer swap 2.36% and pays on the payer swap every 6 months 2.33%. Hence, the yearly profit of the bank, acting as an intermediary, can be calculated as follows. We take the difference between the ask swap rate and the bid swap rate, 0.0236 and 0.0233, and we multiply that by the notional principal of 50 million euros. If you're entering the figures in your calculator, you should get then a yearly profit of this intermediary activity of the bank of 15,000 euros. On the next slide, we discuss how to calculate the fixed and floating payments on an interest rate swap. The fixed payment of an interest rate swap is calculated taking the notional principal of the interest rate swap times the swap rate, and the swap rate is multiplied by the actual days in the interest period divided by 365 days. So that's the day count convention that we have typically in the capital market. The floating interest payment, on the other hand, is calculated taking the notional principal times the floating rate. The floating rate is a reference rate in the money market, and we use now the day count convention of the reference rate, which is for the EURIBOR and the Swiss average rate overnight for the Swiss franc, actual 360. So we take the actual days in the interest period divided by 360 days. Let's take now the following example to calculate the interest payment of an interest rate swap. An interest rate swap with a tenor of 10 years and a notional principal of 50 million euros has a swap rate of 2.382%. Interest payments are made quarterly at the beginning of the interest period, that's on the 19th of September 2024. The 3 months EURIBOR is 3.455%. What is the interest payment at the end of the interest period on the 19th of December 2024 for the holder of the payer swap and the receiver swap? The holder of the payer swap pays the swap rate. The swap rate is 2.382%. So I take here the holder of the payer swap. The swap rate is 0.02382. The number of days that we have in the interest period from the 19th of September to the 19th of December 2024 is 91 days. The 91 days can be calculated as follows. We have from the 19th of September to the end of September 11 days. Then in October we have 31 days, in November 30 days, and 19 days in December. So the total is 291 days. The day count convention used for the swap rate is a day count convention that we have in the capital market, actual 365 days. And that's multiplied by the notional principal of 50 million euros. If you're entering the figures in your calculator, you should obtain an interest payment of 296,934.25 euros. The holder of the receiver swap pays the floating rate. The floating rate is a 3 months EURIBOR, which is 3.455%. We calculate the interest payment for the holder of the receiver swap. The 3 months EURIBOR is 3.455%. The number of days that you have in the interest period from the 19th of September to the 19th of December 2024, that's 91 days. And we divide that by 360 days using the day count convention for the EURIBOR, which is actual 360. That's multiplied by the notional principal of 50 million euros. If you're entering the figures in your calculator, you should obtain then an interest payment of 436,673.61 euros. The net interest payment that the holder of the receiver swap owes to the holder of the payer swap can be calculated as follows. We take the interest payment of the holder of the receiver swap of 436,673.61 euros, and we deduct from that the interest payment of the holder of the payer swap, which is 296,934.25 euros. Hence, the net payment is calculated taking the interest payment of the holder of the receiver swap, which is 436,673.61 euros, minus the interest payment of the holder of the payer swap, which is 296,934.25 euros. That's a net interest payment of 139,739.36 euros. That's the net interest payment that the owner of the receiver swap makes to the owner of the payer swap. In this example, the 3 months EURIBOR is 3.455% and exceeds the swap rate of 2.382%. As long as the 3 months EURIBOR is above the swap rate, the holder of the receiver swap makes a net interest payment to the holder of the payer swap. In the case that the EURIBOR falls below the swap rate, the holder of the payer swap must make a net interest payment to the holder of the receiver swap. On the next slide, we discuss how to transform a floating rate note to a fixed rate debt position. If a firm has a floating rate loan or note outstanding and the firm expects an increase in interest rates, then this interest rate risk exposure can be hedged using an interest rate swap. Let's take the following example to illustrate this concept. At the beginning of January 2018, a company has a floating rate note outstanding with a time to maturity of 10 years and a par value of 100 million euros. The coupon rate of the floater consists of the 6 months EURIBOR plus a quoted margin of 75 basis points. Since the company expects rising interest rates and thus higher capital costs, the firm decides to enter into a 10-year payer swap with a notional principal of 100 million euros, which is the same as the notional principal of the floater that the firm has issued in early January 2018. Interest payments are made semi-annually. The swap rate is 0.866%, while the floating rate is given by the 6 months EURIBOR. And now we have to determine the net interest cost. To visualize a transformation of this floating rate note to a fixed rate debt position using a payer swap, let's take the figure on the next slide. We have here the balance sheet. We see the assets and liabilities and equity. And on the liability side of the balance sheet, we see the floating rate note issued by the firm. The coupon rate on the floater is given by the EURIBOR plus 0.75%. The risk is now for the firm that interest rates increase. If interest rates increase, the reference rate will increase, so we have a higher EURIBOR, which leads to higher coupon payments. The firm can hedge this interest rate risk entering into a payer swap. The firm pays the swap rate of 0.866% and receives the EURIBOR. The EURIBOR cancels out. The firm pays the 6 months EURIBOR on the floating rate note issued and receives the EURIBOR on the payer swap. Hence the EURIBOR cancels out. To calculate now the net interest costs, we can take the quoted margin of the floating rate note, which is 0.75%. That's a fixed amount and does not change by a change in the level of interest rates, 0.75%, plus the swap rate that the firm pays through the payer swap, which is 0.866%. That gives net interest costs of 1.616% and multiplied by the notional principal of 100 million euros gives then net interest cost expressed in euros of 1.616 million euros. With the help of the payer swap, the floating rate note is converted into a fixed rate debt position with a fixed annual interest cost of 1.616% or expressed in a currency 1.616 million euros, independently whether interest rates rise or fall.